Hi, it's Dre Griggs with Same Wisdom. Today we answer the question, what is the tax impact of selling our home in retirement? When we're deciding whether or not we want to sell our home in retirement, we're normally thinking of it from the perspective of, do I want to continue living in my house? Normally the house is maybe a little bit too big, or we have upstairs and we don't want to go upstairs anymore. Maybe we want to move to a new location where the weather is much better. There are so many things that we're thinking about when we're deciding whether or not we want to relocate. But one of the things that we don't think about enough is the tax implications of selling our home in retirement. So today we're going to discuss 7 key considerations from a tax perspective when you're deciding whether or not it makes sense for you to move from your home. The first one is the capital gains tax. One of the cool things that we don't get to talk about a lot is we have this primary residence exclusion, which means if it's my primary residence, you'll say, all right, Dre, well, what qualifies as my primary residence? It means that you would have to live there 2 of the last 5 years. If that is the case for you, you get the primary residence exclusion. If you file your taxes single, then when you sell your property, $250,000 of the net proceeds, and when I'll give you a case study at the end where we go through it, but $250,000 of your net proceeds or your profits might be a nicer way to say it, that is excluded. So if you sold your house and you made $200,000, you would not pay any capital gains taxes as long as you qualified by it being your primary residence and you lived there 2 of the last 5 years. If you're married, it actually doubles. So if $500,000 becomes the amount that you would have to clear to even have to worry about taxes at all from selling your home. Now, for those of you that would be above that exclusion where you made more than $250,000 from the sale of your home as an individual, or you made more than $500,000 from the sale of your home as a couple, you would then have the much more favorable capital gains tax rate, which is normally going to be, depending on your tax bracket, I'll put a table up for you, but normally it's going to be 0, 15, or 20%, which is going to be much more favorable than the normal where you'll see the highest of an individual's tax rate will be at 37%. But that is not the only tax consideration that we should have when we're deciding whether or not we want to sell our home. Number two on our list is the impact on Medicare premiums. You pay Medicare premiums for Medicare Part B, which is your visiting the doctor, your outpatient care, your preventative services, your durable medical equipment. All of that, you have this monthly premium that you will pay. Medicare Part D is your prescription drug benefits. Both of those have a monthly fee that is attached to them that you would be paying as far as your premium every single month. Well, that premium can have a surcharge if you make a certain amount over what the minimum is. In 2024, the minimum that will jump you into where you have that surcharge is $103,000 for an individual and $206,000 for a married couple. Well, you and I can see that even though you're below that 250,000 as an individual or $500,000 as a couple, where I'm not paying any capital gains taxes, I might end up paying what amounts to a tax on my Medicare payments for the rest of my life because I made more than that those past 2 years. Medicare does what's called a 2 year look back. So the 2 years before you apply, they look at how much your income was. And then based on that income, that impacts what your monthly premiums will be, which is why it's very important to have a comprehensive retirement plan right before you retire, because whether or not you're accessing Social Security and then still taking your income, or you access a lot of your retirement funds and you take that in as income because you wanted to remodel your house right before you retired, or even if you just sold your house, all of these events that happen right around the time of your retirement could bump you in a significantly higher Medicare bracket. And they actually added those. It hasn't been that long. It was 2003 when they started adding these income adjusted brackets. And so as a result, you want to be very mindful. Now, they do have a process, which obviously none of us would want to go through with the government, but they do have a process where you can say, look, I had a life event. I had extenuating circumstances. I don't think I should have this premium based off of this income for the rest of my life. Now, as you know, it's not the easiest thing to get the government to agree to give you back some of your money. So I would rather have a plan ahead of time that gives me the flexibility to make sure that I don't have too much of an income that I'm claiming the 2 years before I retire. Number three on our list is your state taxes. So we already talked from a federal perspective where you have that primary residence exclusion of 250 or $500,000, but your state might not have those same rules. Some states do. Some states do have exclusions for primary residence, but other states don't. Now, me hanging out in good old state of Florida, we don't have state taxes. So if you're in Florida or a state that doesn't have state taxes, then you don't have to worry about it at all. But depending on the state that you're in, you'll want to take a look to see how they treat the selling of your primary residence. Is it excluded up to a certain amount, or do they make you claim it all as income? Because if they make you claim it all as income from a state perspective, then even though you'll be excluded from federal taxes, you will have to pay state taxes on that amount. Number four on our list is your property tax adjustment. So normally when you have your property taxes, you have that at escrow and then they pay it out each month for you. And then they give you the new amount at the end of the year because your taxes go up and your insurance goes up and all these other expenses go up. Well, if you sell your house in the middle of the year, you may be responsible for that prorated amount. They may take over for the rest of the year, depending on when you sold your house, but you will be responsible for that prorated amount. You want to keep in mind when you're purchasing that new home, whatever your assessed property value is, that could increase or decrease your property taxes. Now, for a lot of us, it actually ends up increasing it. So, for example, in the state of Florida, we have these laws where your property value and the taxes can only go up so much. It was basically the idea was back in the day, the value of someone's home would go up and the taxes would go up a lot with it. And then someone who was older and retiring would basically be priced out of their own home where they would have to sell it because they couldn't make that payment. So in Florida, we have these laws where it's a very small step up. And then when you sell the home, Florida then adjusts whatever the value is to that new person purchasing it. So you may go and look online and look at your property assessed value, and it says like $100,000, $200,000. And you're like, okay, this is great. But then when you purchase it and they reassess it, you're like, whoa, that's a lot more in taxes than I was expecting. So you just want to keep in mind that sometimes when we make that move, we might have laws that are very favorable for being in the house for a long time. And then when you move, you get reset to whatever the new environment is, where you're not being grandfathered into the old environment. And sometimes that jump is a little bit more than what we expect. I've seen that a couple times. So it is just something that you want to keep in mind, or something that I would at least be mindful of, that maybe what I'm estimating my new property taxes to be is actually going to be a lot more than what I'm currently paying. Even though I might buy a similar valued home, I just had this old grandfathered rule where it wasn't stepping up the same amount. Number five is just a reminder that you may have to report the sale of your home. Even if you don't have to pay capital gain taxes on it, you sometimes have to report it on the IRS Form 8949 as Schedule D. And especially if you were given a 1099-S from the real estate agent or the title company, then you're going to have to put that in your tax return. And while this may not change the bottom line of your tax return, it is something that may change the way you file it. And from that perspective, that's something that I would want to know if I was planning on selling my home in retirement. Number six on our list is just the impact on your retirement income. I do have multiple videos and I'll share some of them, like the one where we go over the tax on Social Security. And all that means is if you make over a certain amount of money, that you may find that up to 80% of your income is now considered taxable income. And that is something that a lot of people are very surprised by, that your Social Security can be taxable even up to such a high percentage. And if you're over a certain income, that's definitely going to happen. Also, if you take it just from a regular tax bracket perspective, and I'll put a link to a video where I go over 9 tax strategies to make sure that you limit your taxes. And what you'll see in that video is we want to keep track of what our overall tax bracket is. And I'll put a chart where you can see what the tax bracket levels are. If you find yourself teetering in one of those brackets, selling your home might be something that you need to do a little more strategically, where if you were to take that income in, even though I have the primary residence exclusion, it doesn't change the way some of my other assets are taxed. We already talked about Social Security, but your other retirement accounts as well, where you're taking money out of your pre-tax accounts, like your 401k and your 403b. Well, when you take that money out, it's taxed at your ordinary income tax bracket. Well, if your income is higher because you sold your home that year, instead of you having a lower tax bracket because your thought was, well, when I retire, I'm going to make less, I'm going to live off of like 80% of my income, that's going to put me in a lower tax bracket. So as a result, I'll save on the taxes. Well, now that you sold your home, all of a sudden it may push you into a higher tax bracket. And now you're paying taxes on an income at a higher rate than you would have if you'd taken it in while you were working, which most of us don't want to do. Most of us are not trying to put off our taxes to pay a higher tax bill in the future, but it does happen. So you want to keep a track of what your income levels are, just to make sure that you don't accidentally move yourself into a higher tax bracket. And our seventh and final tax impact to selling your home in retirement is just what you can deduct. Sometimes we're able to deduct our selling expenses, like improving the house or my legal fees or what I paid to the real estate agent, or sometimes we're able to use some of these deductions to lower the amount of our taxable capital gain. For example, if you had John and Mary who were going to sell their house for $700,000, you see they purchased their home for $300,000, made $50,000 worth of improvements over the years, their net capital gain would be the sale price of $700,000 minus the purchase price plus improvements, which is $350,000. That means their capital gain would be $350,000. That would be the profitable amount that they had. Now, because they're a couple, they would then have the exclusion amount of $500,000, which means they would not be taxed from a capital gains perspective. Now, if for some reason they sold the house for $1 million, then the $350,000 they were able to exclude, that will still leave $650,000. Well, you take off the $500,000 for being the primary residence where they lived 2 of the last 5 years, that would still leave $150,000 as taxable capital gains income. So you can see how selling your home during retirement could be a complex financial event that has a variety of tax implications, which is why it's so important to have a comprehensive strategy, because you not only understand this from a taxable income perspective, but from your Medicare perspective, from your state tax perspective, and your federal tax perspective, and a lot of other considerations where if we're not being mindful of everything, we may put ourselves in a really tough spot. If you found value in this video, I simply ask for you to like and subscribe so you continue receiving valuable insights on how to create your own wealthy retirement system. Until next time, stay safe and enjoy life.